I'm Rick Kaler. Thanks for joining me. Did you know more than a fourth of Americans think the best long-term investment is money in the bank? I would say this is rather discouraging to hear, and it's a result of a survey by Bankrate. One of the questions was, for money you wouldn't need for more than 10 years, which of the following do you think would be the best way to invest the money? One of the last choices was bonds at 8%. Only 14% would invest long-term money in the stock market. 16% decided gold would be the best thing to own. 23% said real estate. And the top choice, 26% for their long-term investment needs, said cash. Sorry, kind of passed out. Now, this is unbelievable to me. I assume that those who opted for cash did so because keeping money in the bank seemed to be the safest choice. For long-term investing, that safety is a complete illusion. The best and safest place to put your nest egg for the future is not in the bank, but in a well-diversified portfolio with a variety of asset classes. And here's why. Savings accounts and CDs are safe places to store relatively small amounts of cash that you expect to need within the next few months or few years. The funds are protected by insurance. You know exactly where your money is, and that you can get your hands on it anytime you want, and that it will not decrease in value. Now, this short-term safety does not make the bank a good place for money you will need for retirement or needs 10 years you have into the future. It may seem like safe investing because the amount of the account never goes down. You're always earning interest. Yet over time, that interest isn't nearly enough to keep pace with inflation. The purchasing power of your money decreases, which means you are actually losing money. And then there's taxes that will come out of it as well. It just doesn't feel like a loss to you because you don't see a loss in value of the principal amount or that beginning amount. Now, in contrast, the stock market fluctuates. The media reports constantly that the Dow is up or the NASDAQ is down, as if those day-to-day numbers really matter. This fosters a perception that investing in the stock market is risky. Combine that with the scarcity of education about finances and economics, and no wonder that so many people are afraid of the stock market and view investing as a form of gambling. Wise long-term investing in the stock market is anything but gambling. Instead of trying to buy and sell a few stocks as their prices go up and down, wise investors neutralize the impact of market fluctuations by owning a vast assortment of assets. This is accomplished with a two-part strategy. The first is to invest in mutual funds rather than individual stocks. With just one mutual fund that invests in an index of stocks, you might own thousands of different companies. Your hard-earned fortune isn't dependent upon the fortunes of just a handful of companies. The second component is asset class diversification. An asset class is a type of investment such as U.S. and international stocks, U.S. and international bonds, real estate investment trusts, commodities, market neutral funds, treasury inflation protected securities, and junk bonds. Ideally, a diversified portfolio should include 9 or more asset classes. By holding small amounts of a great many different companies and asset classes, you spread your risk so broadly that the inevitable fluctuations are small ripples rather than steep gains or losses. As some types of investments decline in values, other types of investments will gain in their value. Over the long term, the entire portfolio grows. It can be rather boring, but reasonably consistent over 10 or more years. In the long term, investing in this way is usually much safer than money in the bank. Thanks for joining me.